On the Spot with Michelle Makori is brought to you by Prime XBT.
I'm Michelle Makori. Thank you for joining us. The Fed has resumed its rate hiking, raising interest rates by 25 basis points to the highest level in more than 22 years. The markets had expected and priced in the move that now has the Fed funds rate at the 5.25% to 5.5% range. As for future hikes, Fed Chair Powell said that the central bank will make data-driven decisions on a meeting-by-meeting basis.
I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
Powell also said that he does still see a possibility of a soft landing for the economy. Well, here to help us analyze the latest from the Fed, what it means for the economy and for your portfolio is Danielle DiMartino Booth. She is the CEO of QI Research, former Fed insider, and the author of Fed Up, an insider's take on why the Federal Reserve is bad for America. Danielle, welcome back to Kitco. Always good to have you with us.
Thank you, Michelle. Good to be here again.
And especially good to have you considering you're joining us from vacation. We really appreciate it. So we'll get straight to it. Danielle, we had the Fed hike by 25 basis points, pretty much as expected there. There were very minimal changes made to the post-meeting statement. What was your main takeaway from what we heard today?
So, inflation remains elevated. That was my biggest takeaway. And, even though Jay Powell is cognizant of the fact that monetary policy has started to impair the flow of credit to the U.S. economy, he feels right now that the primary responsibility that he has and members of the Federal Open Market Committee have is to get inflation all the way down to that 2% target. He obviously, he was pointedly asked by one of the reporters, and you played the clip, is September a live meeting? He said it is indeed. We're not necessarily going to slow the pace of rate increases until we have a substantial body of evidence that justifies doing so.
Right. And it's interesting because he also did say that he expected inflation to only hit that 2% target by 2025. So what does that signal?
Well, to me, if nothing else, that signals that he plans to continue reducing the size of the Federal Reserve's balance sheet. And that's what that tells me. There could be a pause in raising interest rates in the future. I certainly wouldn't think that in 2024 we would see a continuation of rate increases. Even the dot plot from the last meeting told you as much, that Fed policymakers as a group only anticipate one more rate hike, and for that to occur in 2023. But I think when he mentions inflation not coming to target for a very long period of time, what he's saying is this is how higher for longer is going to manifest. We're going to keep rates at a very high level for longer than markets anticipate or certainly are used to, in order to get that inflation down to target, all the while shrinking the balance sheet, continuing to deplete liquidity from the system.
Right. And Danielle, Powell did acknowledge that it takes time for this tightening to really start to manifest itself in the economy. And it's interesting because many people have said that the Fed has not given it enough time to date to really start to kick in. We heard from billionaire bond king 𝗫𝗕𝗓 Gundlach, the founder and CEO of DoubleLine Capital, shortly after the Fed press conference. He was on CNBC, and he said he does not think that Powell and the Fed should have hiked again today. What do you think? Do you think that the Fed is giving the economy enough time to process all of this tightening?
I don't think that we have seen the full brunt, the full outcome, the full damage that rate hikes past are going to take on the economy. The New York Federal Reserve put out a survey just a few days ago that indicated that that lenders that extend credit for mortgages and auto loans and credit cards, that they foresee going out into the future the highest rejection rates for U.S. households in the history of them doing business. So these are very interesting times that we're in here, because whether you're talking about commercial and industrial loans declining or forced bank mergers, as we saw out west yesterday, there is obviously some damage being done by Federal Reserve policy. And yet, you know, when Jay Powell was asked about restricted lending, tightening lending standards, he basically brushed off the idea. He said that, you know, he previewed Monday's release of the Senior Loan Officer Opinion Survey and said, yes, it's going to show that lending standards have tightened. That's actually the job of monetary policy. It shows that we're being effective in what we're doing.
So do you think that there should have been a hike again at this meeting?
I think that if Jay Powell is trying to shrink the size of the Fed's balance sheet and change the narrative, Michelle, change the narrative away from zero interest rate policy, take quantitative easing away from the Federal Reserve as a future tool. If he's going to do that, he's going to have to maintain a higher for longer policy, regardless of the damage that it might or might not do to the U.S. economy. I think he's trying to say that there will be casualties in order for the Fed to extricate itself from failed monetary policy.
Well, let's talk about those casualties, because he did also say that he does think that there is a possibility of an economic soft landing. Now, as you and I have discussed before, we take everything that the Fed chair says with a very, very big grain of salt. But he did indicate that a soft landing is still on the cards. Let's take a listen.
It has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view. And I think, you know, that's sort of consistent with what I see today. So, but it's a long way from assured, and you know, we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast. But given the resilience of the economy recently, they are no longer forecasting a recession.
So no longer forecasting a recession. And look, Danielle, we know that markets largely expected a recession to kick in by the first half of this year. That didn't happen. The odds of a recession are falling, at least according to many of the mainstream banks and economists. Goldman Sachs, for one, trimming the estimated probability of a U.S. recession over the next 12 months to 20% from 25%. What is your outlook regarding when we may see a recession, if at all?
So, you know, it's interesting that you asked, because, you know, with the most recent data that we have in hand, we know that the U.S. federal government has just spent $6.7 trillion in the most recent fiscal year. The height of the pandemic, we saw $7.6 trillion being spent. So just $900 billion less. A lot of the money that is being pumped into the U.S. economy is forestalling recession. The Employee Retention Credit, it's an IRS program, is pumping $30 billion a month into the U.S. economy. That money's being spent immediately. We still have massive levels of federal fiscal stimulus that is holding up this economy. And yet at the same time, 93% of the U.S. population is living in a state with rising continuing jobless claims. Last September, that percentage was 0. So we definitely have a very slow rolling recession that is moving in. It looks like we're going to have Yellow Trucking, a very large company that employs 30,000, go straight to Chapter 7 liquidation as opposed to Chapter 11. That's going to make a few headlines as well. There are pockets of severe weakness, but Uncle Sam is still spending money like a drunken sailor. So it's really difficult to slam the U.S. economy into recession when the U.S. government is still acting as if we're in the midst of the worst days of the public health emergency.
Right, and I get it. You can't have monetary policy go in a totally different direction to fiscal policy, especially if you're trying to achieve some kind of result. But we are still seeing what seems to be a surprising resilient economy, at least according to the equity markets and some of the latest government indicators. For example, the US employment picture still continues to look pretty good. Payrolls climbed by 209,000 in June, even though that was below economists' forecasts, still a healthy pace. Unemployment rate fell to 3.6%. Average hourly earnings rose 4.4% on a year-over-year basis. Now, granted, unemployment is a lagging indicator, but still looking pretty robust there. And U.S. consumer sentiment also rising to an almost 2-year high in early July. So I'm wondering, what do you make of that, Danielle?
Again, I'm a broken record. I go back to the fact that if you provide American households with $30 billion a month in money to spend, that they're going to spend it. We have Americans at the highest number of Americans since 2010 taking out home equity lines of credit on their homes. Is it 8 or 9% that they're spending in terms of borrowing costs? It is, but they're still pulling money out of the trillions of dollars of home equity that's sitting there. We've got record levels of credit card spending as well. So there are certain aspects of the U.S. economy that remain very much pillars of support. Are they sustainable? Well, we'll see when it comes to the fiscal spending that's going on. I think at some point the level of fraud in this particular program will get some of the more conservative politicians' attention.
All right, let's unpack that. The level of fraud, what do you mean by that specifically?
So the Internal Revenue System, the IRS has already come out and said that they're concerned that these employee retention credits that have gone from about $15 billion a month a year ago all the way up to $33.2 billion for the month of July, that they're concerned that at this juncture, paying businesses to retain employees because of their business was interrupted by COVID might be a program that is riddled with fraud. And my answer is, when we were at the very tail end of the subprime mortgage crisis, indeed what we saw were the vast majority of mortgages being underwritten at that juncture were fraudulent. So it's very difficult to when you've got getrefunds.com, innovation taxes, companies one after another soliciting these employee retention credits successfully. They collect 15, 20, 25% of the proceeds. It's very difficult to get a program of this kind under control unless you have Congress come out and cancel it, because it's very, very obvious that we should no longer be spending record levels, $30 billion a month, on businesses that were interrupted due to a pandemic. And
right.
Yet here we are in July of 2023 talking about just that and seeing international travel absolutely go haywire, because so much of the money going into the hands of wealthy American families and businesses, it's going straight overseas. They're shopping on the Champs-Élysées, and we're seeing it in the actual data. So again, Uncle Sam's money got at work.
All right. So I hear what you're saying, that the economy is still surviving on all of that excessive artificial stimulus that we had. But at what point do you think that starts to wane, if at all? Do you still have a recession in your forecast? And if so, when?
I do, because when you look at the most recent reading from the Chicago Federal Reserve National Activity Index that came out at the very beginning of this week, it's the broadest gauge of the U.S. economy that we have out there as economists to pull upon. 85 separate indicators that come together in one index. Of those 85 indicators, 56 are contracting right now. So it is very much in large part that the stock market is holding up the confidence level of the U.S. economy right now. 89% of Indeed.com categories of job postings, 89%, Michelle, are negative year over year. We are seeing the demand for labor absolutely collapse. But again, you can create a lot of smoke and mirrors when there's this kind of public fiscal spending going on headed into an election year when nobody really wants to stop that from occurring.
A lot of smoke and mirrors. And as we've discussed before, even though inflation seems to be coming down, it doesn't really feel like it's coming down to those of us that are paying bills here. I want to talk about what we touched on when you were on the show last time, and that, of course, is the banking system. Now, Fed Chair Powell said that the banking system remains sound and resilient, but that he continues to monitor the sector. Now, last time we spoke, you said that we were in the middle of a banking crisis. We're just not calling it then, and that you expected more bank collapses. At the time, we did just see the collapse of Silicon Valley Bank and Signature Banks, and this was before the First Republic collapse, so you were definitely correct on anticipating that one. But it seems like the banking system appears to be somewhat more stable. What's your read? Where are we in terms of any future banking collapses?
Well, after First Republic, the assumption in the investing community was that PacWest would be the next bank to go. Of course, there was a forced merger just yesterday between PacWest and the Bank of California. So what we're seeing is something that is slow moving in nature. But if you're having forced marriages and JP Morgan announcing just a few minutes ago that it's going to be buying $2 billion of mortgages from this brokered deal, we're clearly still in a situation with tightening lending standards. And again, what we're seeing right now in commercial real estate, and that is the next shoe to fall for American banks, what we're seeing right now is a lot of extending and pretending. If it's trash, it's being traded. If it's a trophy, it's being traded. If it's trash, they're simply sending back the keys to the lender. And if it's a very good office property, that's trading as well. But everything in the middle is right now frozen. And you're hearing one bank after another say, we're having to pay up to keep our deposits. And that means continued compression with net interest margins. I doubt that the PacWest forced merger with Bank of California is going to be the last one that we've seen, but PacWest was indeed that next domino that was going to fall, and it has fallen.
But you've called this a controlled demolition.
Demolition, yes.
So what do you expect to happen next, and what do you mean by a controlled demolition?
I mean to say that you're not waking up tomorrow and finding out that the largest junk bond exchange traded fund is no longer accepting redemption requests. We're not seeing a complete collapse in credit in the aggregate right now. What we are seeing is the fastest pace of bankruptcy filings since 2009. But it's one company at a time. And many of these companies are preemptively actually filing for Chapter 11 because they know that they're not going to be able to refinance their debts when the time comes. So as long as it's one company at a time, even if it's as big as $5 billion Yellow Trucking with 30,000 employees going straight to Chapter 7 liquidation, even if it's that big, as long as there's no contagion, Michelle, we should be fine. And that's what a controlled demolition looks like. If there's contagion, as there was in 2018, when Powell was prompted to pivot, when there were no junk bonds being sold in the United States at all, that's a different scenario. And that would prompt him to come in and be very quickly easy with monetary policy. But we're not there yet.
Well, you say there yet, right? So there hasn't been this massive event that creates this ripple of contagion so far. Is that to say that A, you anticipate that happening, and that B, perhaps the Fed has done a better job than expected in managing this?
Well, it's clear that Chair Powell has been able to exploit the stock market being high in the sense he's been able to continue on his tightening path. I take my hat off to him. If he's ever going to normalize monetary policy and set up the United States economy to be one that does not have to subsist with zero interest rate policy, then he's going to have to normalize policy. He's going to have to get rates up and keep them up at a certain level. Maybe say 2% is the new floor. But we haven't seen anything disastrous occur just yet. What we are seeing, however, is one company after another in the current earnings season disappoint and guide downwards and say, as Packaging Corporation of America said, the third largest publicly traded packaging corporation in America, they came out and said that their containerboard, their box sales were down 9.8% quarter over quarter, one of the worst that they've ever seen in their history, and that the anticipated recovery in the U.S. Economy that they foresaw occurring in the second quarter has not happened, and that companies continue to destock. But we're seeing this one company after another. We've seen backlogs decline for 14 months in a row in the manufacturing sector. We will see that manifest as a continued rise in continuing jobless claims.
All right, so back to the banking sector, Danielle. Do you think that we are still at risk of more banks collapsing?
Well, I think if the FDIC is busily brokering mergers while we're sleeping, Michelle, that there certainly is that possibility. There's no reason to believe, with commercial real estate prices falling as fast as they are and interest rates being as high as they are, that you're going to somehow magically have some immaculate refinancing wave where companies are able to go from the loan that they used to have against the property at 3% all the way up to 9% and somehow survive. It just doesn't work like that. And we know that the regional and the smaller banks are up to their eyeballs in these commercial real estate loans that will have to be refinanced at some point. And that will cause more, hopefully, more mergers that we're seeing as opposed to bank failures that incite contagion. But what we saw was a bank failure in the last 24 hours. So this is not over.
All right, so you're seeing consolidation of the banking sector, which tends to, in a way, mask the impact of the collapse, I suppose, at least to the less sophisticated viewer.
Well, it's certainly not a headline grabber. It's not, America's not running out and saying, do I pull all of my deposits from my banks because there was a West Coast bank merger?
Yeah.
So it certainly is not the same kind of headline grabbing, the theater is on fire type of situation. And I guess hats off to the FDIC for being able to broker that deal quietly.
Right. And you anticipate more consolidation then in the banking sector, more of these mergers happening, perhaps, as you say, quietly, discreetly, and not causing mass panic.
Well, I'm just going off of what Chair Powell said at the podium today, and that's that the senior loan officer survey that's coming out on this coming up Monday is going to show further tightening of credit standards, further tightening of lending standards. At last check, Michelle, banks are in the business of lending. And if they're tightening lending standards, that means that there are fewer loans being made, and that means that there's less business to go around and that we'll see more distress in the banking system.
Well, speaking of credit, you had discussed the liquidity drain of the Treasury filling up its coffers, the Treasury General account, and that could be a potential liquidity event. How is that playing out? Where does that stand at the moment?
Well, we've seen the first $300 billion go by, and it's been okay. We've seen some movement out of one of the Federal Reserve's facility into Treasury bills. Of course, now September's a live meeting. We could see another rate hike coming there. So we don't know that money market funds are necessarily going to continue to buy up these billions and billions of dollars of treasuries. And banks may be getting to the point where they own enough treasuries themselves. We will see how this goes with this next $300 billion. Bank of America's Michael Hartnett has warned that we're seeing $100 billion of liquidity coming out of the global financial system on a monthly basis. And that's going to continue. That was, of course, mitigated when Treasury Secretary Janet Yellen was emptying out the Treasury General account. That is no longer the case. It's moving in the opposite direction. So we will feel the brunt of global quantitative tightening more than we were when we were in the midst of a debt ceiling standoff.
And as we discussed, the markets have been surprisingly resilient. The S&P 500 up, about 19% year to date. A lot of that has been on the hope of rate cuts. Powell said that he does not see any rate cuts this year, potentially next year, but that will be a judgment that they would have to make next year. What's your read on that?
I think markets continue to trade based on hope. I would agree with that assessment very much.
And what is the hope of a rate cut?
I think that hopes for a rate cut would be something that we would be talking about, I think, a year from now.
Okay, as we wrap up, because I know we're short on time, Danielle, last time we had you on, you said be bold in your gold investing. You said that now would be a good time to be bold in your allocation to precious metals. Mm-hmm. Where do you stand on that? Is that still your thinking there?
It's certainly still my actions. And, as we see Germany fall deeper into recession, and we see that China is not able to rescue the global economy as it has in the past, and we do see other central banks continuing on this tightening path, I would say that that's certainly still an appropriate stance.
Is that more than the traditional 5%, 5 to 10% allocation? Should one be bolder than that? And I understand that individuals' circumstances vary, but how are you positioning yourself there?
I do have more than I would normally have in gold, but by the same token, I have more than I would normally have in cash because it's paying me 6%. So we're in kind of extraordinary times right now. And I think that what people don't appreciate is that when there are alternatives to taking risk, that people will slowly but surely become a little bit more risk averse in how they position their portfolios, and appropriately so.
And how should you be positioning your portfolio? How are you positioning your portfolio these days then?
Well, as I said, I'm making 6% on my cash right now, very happily. So my municipal bonds continue to pay me very well, as does my gold. We have private investments as well. But am I in the stock market? If that's your question, right now I'm not in the stock market.
You're not in the stock market at all?
Me personally, no.
No exposure to equity markets at the moment?
Zero.
Wow. Okay. That's a big.
Now, that's not to say that our clients are positioned that way. You asked me about my personal portfolio. There are plenty of places where you can hide in the stock market right now. But my feeling on aggregate valuations is that they simply are not in a place where a black swan event couldn't take them down very much precipitously. So
you have zero U.S. equity market exposure at the moment. All right. Danielle, before we let you go, tell us about your new venture, QI Intelligence, I believe it is.
QI Research. We've just rebranded the name. It's still the same exact company. It's just the research we produce is better and better. We really are enjoying our new home on Substack, 𝗍𝗿𝗶𝗺𝗲.substack.com. And we're enjoying the increasing reach of our research and our client base. I was at a big event today in Sao Paulo, virtually, of course, but it's been fun to watch the company grow and to get a larger client base. Of course it is.
All right, QI Research. And based on that research, you have zero exposure to equity markets at the moment. Just want to be clear on that in your personal portfolio.
That is me personally, but I certainly do guide clients in terms of where to position themselves sector-wise in the stock portfolio, their stock portfolios.
And why have you taken that position of no exposure in your own portfolio right now?
I think that you get alternatives that provide you with a lot less in the way of downside, and I think that your longer duration treasuries right now are a screaming buy. So there are other places to be.
All right, and those places being treasuries, you said a strong allocation to precious metals. Where else?
And cash.
And cash. All right. Well, Danielle, we appreciate you taking time from your vacation. Looks very scenic and lovely over there. We'll let you rejoin your family. Thank you so much for joining us as always. Really appreciate it.
Thank you for your time. Take care.
All right, Danielle DiMartino Booth, thank you. And as always, thank you for watching. Of course, a big thank you to our sponsors, Prime XBT. And a special reminder to Kitco viewers, there is an offer from Prime XBT in the description of our video, so make sure to check it out. For me, Michelle Makori, and the rest of the team, we'll see you soon. Thanks. Bye-bye.
Begin your path to financial freedom. Gain up to a $7,000 bonus on us. Register and use promo code. Deposit and enjoy a 7% bonus. Available now. Link in the description.